Digital Assets for Investors. Chapter 15, Building a Digital Asset Strategy. Section 1, Long-Term Investing. Long-term investing in digital assets means you are not trying to win every week or every month. You are buying an asset because you believe the underlying network can become more useful, more adopted, and more valuable over a period of years. That usually means accepting that the price path will be uneven, with rallies, corrections, and long, quiet stretches along the way. In practice, the question is less, what happens this week, and more, will this network matter more 3 to 5 years from now? This is very different from frequent trading, where short-term price moves are the main focus. A long-term investor cares more about utility, adoption, security, and staying power than about daily market noise. The mindset is what makes this strategy workable. If you plan to invest for 3 to 5 years or longer, you have to expect severe drawdowns and periods when the market feels deeply uncertain. In digital assets, a drop of 50, 60, or even 80% is painful, but it is not automatically proof that the original thesis was wrong. The discipline comes from staying anchored to the reason you bought the asset in the first place. When price falls sharply, the real question is whether the fundamentals have deteriorated, or whether volatility is simply doing what volatility does. That is why headline-driven decisions are so dangerous for long-term investors. They can push you to abandon a sound plan at the worst possible time. Compounding in digital assets often comes less from smooth annual returns and more from remaining invested across multiple market cycles. If an asset survives, grows its user base, and keeps strengthening its network, time can do a lot of the heavy lifting. Some investors also earn staking rewards, which may add to returns, but those rewards are never free money. They come with their own risks, including lockups, validator risk, slashing risk, and changing token economics. This is why volatility tolerance matters just as much as conviction. You can have the right idea about an asset, but if the swings are too large for you to hold through, the long-term thesis may never get a chance to play out. A strategy only works if your temperament can actually support it. Long-term investing does not mean buying something and forgetting about it. It means reviewing it on a schedule with attention focused on the health of the network, rather than every short-term price move. Over time, you want to monitor development activity, because active builders often signal an ecosystem that is still improving. You also want to watch network security, user and community growth, regulatory conditions, and whether real-world adoption is expanding or fading. A useful habit is to revisit your thesis with facts every quarter or at least once a year. The goal is not constant reaction, but steady verification that the asset is still healthy, competitive, and relevant. Building a long-term position usually starts with a few simple decisions done well. First, choose assets with durable fundamentals rather than chasing whatever is attracting the most attention right now. Second, decide how much of your overall portfolio should be in digital assets, and keep that allocation realistic for your risk tolerance. Third, think seriously about custody, because a long holding period only helps if the assets are stored securely. Finally, many investors use dollar cost averaging so they can build exposure gradually instead of committing all their capital at once. That approach can make the process steadier, especially in a volatile market. Just as important, long-term capital should be money you are unlikely to need in the near future. Dollar cost averaging, or DCA, means investing a fixed amount on a regular schedule, regardless of what the market is doing. If prices are high, that fixed amount buys fewer units, and if prices are low, it buys more. The main benefit is that it reduces the risk of putting all of your money in at exactly the wrong moment, such as a local market peak. It also makes investing more systematic, which can be especially helpful when prices are moving sharply in both directions. For many people, the greatest advantage is behavioral. It replaces guesswork with consistency. DCA does not guarantee profits, and it will not always outperform a lump sum purchase, but it often makes a long-term plan easier to follow. A strong long-term process draws a clear line between normal volatility and genuine deterioration. Falling prices by themselves do not necessarily mean the investment case is broken, because digital assets regularly experience large swings. That is why it helps to review on a quarterly or annual schedule, using predefined checkpoints rather than emotional reactions. You might ask whether development is still active, whether adoption is still growing, whether security remains strong, and whether regulation has materially changed the outlook. If those fundamentals remain intact, routine price noise may not require action at all. If the core thesis breaks, though, that is when a long-term investor should reassess calmly and decide whether the position still deserves a place in the portfolio. Valuation tools can be useful, but only if you treat them with humility. In digital assets, investors sometimes use network-based frameworks, such as Metcalfe-style approaches or supply-focused models like stock-to-flow. These can offer context by helping you think about adoption, scarcity, or market expectations, but they are not forecasting machines. A model can suggest that an asset looks stretched or undervalued relative to certain assumptions, yet the real world may unfold very differently. That is why valuation tools work best as one input among many, alongside adoption trends, competitive dynamics, regulation, and risk. Good investors use models to frame questions, not to pretend they have certainty about future prices. Imagine an investor who wants to build long-term Bitcoin exposure with a total budget of $10,000. Instead of making one large purchase, she invests $200 each week over 12 months, using a hardware wallet for custody. Her plan is not built around what Bitcoin does over the next few months, but around owning a meaningful position for 5 years or more. During that year, she periodically reviews security conditions, development, regulation, and whether Bitcoin has become too large or too small relative to her broader portfolio. Some weeks she buys at higher prices and some weeks at lower prices, but the process stays the same. That is a practical example of long-term investing as a system, not as a prediction. Many long-term investors undermine themselves by mixing a long horizon with short-term behavior. One common mistake is trying to time every cycle, which often turns a patient strategy into a series of emotional decisions. Another is confusing volatility with permanent loss, even when the underlying asset may still be fundamentally intact. The opposite error also happens, holding blindly without review and refusing to update your view when facts change. Custody mistakes and investing money that may be needed soon can also force bad decisions at exactly the wrong time. A disciplined long-term strategy is not passive in the careless sense. It is researched, monitored, realistic about risk, and patient enough to let time work when the thesis still holds. Section 2. Active trading. Active trading is a very different activity from long-term investing. The goal is to profit from shorter-term price moves rather than from the multi-year growth of an underlying network. That usually means buying and selling more frequently, sometimes over hours, days, or weeks, depending on the style. Success depends heavily on timing, execution, and risk control, because small mistakes can matter a lot when positions turn over quickly. A trader is usually focused on price behavior itself, not only on long-term adoption or utility. That does not make trading better or worse than investing, but it does make it a separate skill set with different demands. Digital asset markets naturally attract traders because the conditions create frequent short-term opportunities. These markets operate around the clock, so there is always movement somewhere, and volatility can produce large swings in relatively short periods. For a skilled trader, that can mean more setups and more chances to act. But the same conditions also raise the difficulty level. Constant activity creates pressure, fast moves punish hesitation, and a market that never really closes can make it hard to step away. In other words, the features that look exciting from the outside are often the same ones that make active trading so demanding in practice. There are several common trading styles, and they differ mainly by holding period and the amount of attention they require. Scalping is the fastest, with trades that may last only seconds or minutes and aim to capture very small price moves. Day trading typically means opening and closing positions within the same day, so no exposure is carried overnight. Swing trading is slower, often holding for several days or weeks to capture a larger short-term trend. Each style needs a different temperament, schedule, and level of market monitoring. Someone who cannot watch markets closely will usually struggle with scalping or day trading, while swing trading may be more manageable for a person with limited screen time. Active traders usually combine several tools rather than relying on a single indicator. They may study chart patterns and price structure to see how the market has behaved around certain levels. They often use moving averages and momentum tools like RSI to understand trend and market speed. Support, resistance, and volume help them judge whether buyers or sellers are really defending a level. In some cases, traders also include on-chain signals, such as exchange inflows or changes in active addresses, for added context. The key point is that these tools are meant to confirm or challenge a trade idea, not to guarantee an outcome. A trading plan should exist before any money is committed. That means choosing which assets you are willing to trade, defining the exact conditions that would trigger an entry, and deciding how much of your capital you are prepared to risk. A good plan also includes both sides of the exit, where you will take profits if the trade works and where you will cut the loss if it does not. This shifts trading away from prediction and toward preparation. Without a plan, it is very easy to chase a move, oversize a position, or freeze when the market moves against you. The trader who plans first usually makes calmer decisions than the trader who reacts in real time. The trading cycle works best when it becomes a repeatable routine. First, you prepare by building a watch list and identifying potential setups before the market forces you to decide quickly. Then you define the trade clearly, including entry, stop loss, and take profit. After that comes execution and monitoring, where discipline matters because fees, slippage, and emotion can all affect the result. Finally, you review the trade in a journal so that each outcome becomes feedback rather than just another isolated event. Over time, this process helps separate luck from skill. It also reminds you that an edge only matters if it survives after real-world costs. A setup is just a trade idea turned into clear rules. Before entering, the trader decides what specifically triggers the trade, where the idea is proven wrong, and where profits are likely to be taken. For example, an entry might require a breakout above resistance, but the setup is incomplete until there is also a stop loss below a level that should hold if the idea is valid. A take profit level then defines where gains are realized instead of left to hope. These rules reduce emotional trading because they answer key questions in advance. The more precise the setup, the easier it is to act consistently when the market is moving fast. Consider a simple swing trade in ETH. A trader buys half an Ether at $30,200 because the chart is showing higher lows and the 50 period moving average is rising, suggesting short-term trend support. The stop loss is placed at $30,100, which defines the downside if the idea fails. The take profit is set at $3,500, giving the trade a clear upside target before entry. This is useful because the trader already knows the structure of the opportunity, what must happen to get in, what invalidates the trade, and where success is measured. It also highlights that a trade is not just a market opinion, but a plan with prices attached. Trade outcomes are shaped by more than whether price moved in the expected direction. In this example, reaching the target creates a gross profit of $150, but after fees and slippage, the net result is lower. On the losing side, a stop loss may suggest a $50 loss, yet once entry costs are included, the realized loss is slightly larger. This matters because many new traders underestimate how much repeated costs can erode performance. Position size also changes the real-world impact of every trade. Over time, understanding net results instead of gross results is one of the habits that separates serious risk management from casual guesswork. Most trading mistakes come less from chart reading and more from weak risk control and emotion. Volatility and low liquidity can cause poor execution, especially when the market moves quickly and orders do not fill where expected. Fees and taxes add another layer of complexity that active traders cannot afford to ignore. Leverage is especially dangerous because even a small adverse move can become a large loss when borrowed exposure is involved. Emotional habits such as chasing pumps, overtrading, or refusing to honor a stop loss often do more damage than a bad setup ever would. In practice, many traders lose not because they lacked opportunities, but because they lacked discipline. A good way to learn trading is to practice building a simple plan before worrying about profit. Pick a liquid asset, for example, one with more than $100 million in 24-hour volume, so execution is more realistic. Use a 1-hour chart with a 20-period simple moving average. Then define a limit by 2% above that average and a stop loss 2% below it. The point of the exercise is not whether the trade wins. The point is learning how to turn a chart observation into a trigger, a risk limit, and a documented outcome. Repeating that process helps build structure, which is far more valuable than making a few random trades. Section 3. Portfolio construction. Portfolio construction is the step where ideas become a full risk plan. Instead of making an all-in bet on one token, you spread capital across assets in a way that matches your goals, risk tolerance, and time horizon. That means thinking not only about upside, but also about volatility, liquidity, and how different holdings may behave under stress. A well-built portfolio is designed to survive changing market conditions, not just to perform in one favorable scenario. In digital assets, that matters because even strong projects can be highly volatile. The aim is resilience, enough opportunity to participate in growth, but enough structure to avoid one mistake doing major damage. A simple way to organize a digital asset portfolio is to divide it into 3 parts. The first is the core, which acts as the long-term foundation and usually holds the assets you trust most. The second is the satellite sleeve, where you place smaller, higher-risk ideas with more uncertainty, but also potentially more upside. The third is a stablecoin reserve, which provides flexibility, liquidity, and some defense during weaker markets. Each part has a different job, and that is exactly the point. When the roles are clear, decisions become easier because you are not expecting every position to solve the same problem. Allocation should reflect how much risk you can truly carry, not just how much upside you would like to have. In many moderate portfolios, the core may represent roughly 50 to 70%. Satellites take a smaller share, and stablecoins hold perhaps 10 to 20%. A more conservative investor may lean heavily toward core holdings and reserves, while a more aggressive investor may push satellites higher. Time horizon matters too, because someone who can stay invested through deep volatility can usually tolerate a different mix than someone who may need capital sooner. The important thing is that the allocation fits the investor, not the mood of the market. Good portfolio design starts with self-awareness as much as market analysis. Position sizing is one of the simplest and most powerful forms of risk control. In particular, it protects the portfolio from speculative satellite ideas that may sound exciting but carry a high chance of failure. A common rule is to limit each satellite position to about 2 to 5% of the overall portfolio. That way, if one small project goes badly wrong, it hurts, but it does not define the entire result. At the same time, if the idea succeeds, it can still contribute meaningfully to returns. Position sizing lets you preserve upside while putting a ceiling on how much any single speculative bet can damage the whole portfolio. Diversification only helps if your holdings do not all respond the same way at the same time. In digital assets, it is easy to think you are diversified because you own several different tokens, but if they all depend on the same narrative, they may fall together. For example, multiple assets from the same sector can share one risk theme even if their tickers are different. That is why correlation matters. Lower correlation holdings can smooth the portfolio and reduce the impact of a single theme breaking down. In practice, you want to evaluate exposure across ideas and sectors, not just count how many names you own. Stablecoins are often misunderstood as idle cash, but in portfolio construction, they can serve an important strategic role. A reserve in stablecoins can reduce drawdowns in weak markets because part of the portfolio is not moving with risk assets. It also gives you liquidity to act when new opportunities appear, rather than forcing you to sell something else at a bad moment. That flexibility can be especially valuable in volatile markets, where good opportunities often arrive during periods of stress. For many investors, holding 10 to 20% in stablecoins is not about being uninvested. It is about staying prepared. It helps to separate your strategic plan from your tactical adjustments. Strategic allocation is the long-term design of the portfolio, such as a baseline of 60% core, 30% satellites, and 10% stablecoins. Tactical changes are temporary shifts made under specific conditions, such as raising the reserve during unusual uncertainty or reducing a sleeve after a strong run. The danger comes when temporary moves are made emotionally and then quietly become the new default. A written baseline keeps you grounded. Tactical moves can still be useful, but they should follow clear rules and should eventually be measured against the original plan. Over time, markets will push your portfolio away from its intended weights. A winning position may grow much larger than planned, while weaker areas shrink, changing the portfolio's risk even if you never make a new decision. Rebalancing is the process of restoring the original structure by trimming overweight positions and adding to underweight areas or rebuilding reserves. Some investors rebalance on a schedule, such as quarterly, while others use thresholds and act only when a position drifts far enough. The purpose is not to guarantee higher returns. The purpose is to keep the portfolio aligned with the risk plan you actually intended to follow. Consider a moderate $15,000 digital asset portfolio. One simple structure would place 60% or $9,000 in core holdings, 30% or $4,500 in satellites, and 10% or $1,500 in stablecoins. Within the core, you might divide exposure between larger, more established assets such as Bitcoin and Ether. The satellite sleeve could then be split evenly across 6 smaller positions at 5% each, or $750 apiece. This keeps any one speculative idea from becoming too important. The stablecoin reserve adds balance by giving the portfolio both flexibility and a degree of risk control. Strong performance can create a new problem: concentration. Suppose one satellite position originally sized at $750 grows to $2,250, while the full portfolio rises to $16,500. That one position now represents about 13.5% of the portfolio, far above its original role. Rebalancing in that situation does not mean the investment was a mistake. It means the position has become larger than the plan allows. By trimming it and moving some capital back into core holdings or stablecoins, the investor walks in gains, reduces concentration risk, and rebuilds liquidity for future opportunities. Most portfolio mistakes come from weak risk controls rather than from a lack of exciting ideas. One common problem is letting a single asset dominate the portfolio, especially after a strong rally. Another is holding no stablecoin reserve at all, which removes flexibility when markets become stressed. Investors also often mistake similar assets for true diversification, even though highly correlated tokens may fall together. Rebalancing can be mishandled too, either by doing it so often that the process becomes noisy and costly, or by never doing it until concentration becomes extreme. A sound portfolio process is usually simple, deliberate allocation, sensible position sizing, some reserve liquidity, and clear rebalancing rules. Section 4. Research workflows. A research workflow matters because digital asset markets produce far more information than any investor can usefully absorb. Headlines, social posts, charts, rumors, and opinions arrive constantly, but attention is not the same thing as evidence. Without a process, it becomes easy to confuse popularity with quality or urgency with importance. A structured workflow helps filter noise into something more disciplined, collect facts, check sources, compare signals, and only then make a decision. That reduces the chance of buying into hype or panicking during volatility. In a market full of uncertainty, consistency is often more valuable than trying to feel certain. A balanced research process usually uses 3 different lenses. Fundamental research asks whether the project itself makes sense, what it does, how it is designed, who is building it, and whether the value proposition is credible. On-chain research asks whether real activity supports the story by looking at usage, transactions, liquidity, fees, or other network signals. Technical analysis looks at price, volume, and market structure to help with timing and risk management. Each lens answers a different question, so none should be expected to do all the work alone. When used together, they give you a fuller picture of both the asset and the market surrounding it. These research lenses are most useful when applied in sequence. Start with fundamentals so you understand what the asset is, how it is supposed to create value, and what risks are built into the design. Then move to on-chain data to see whether actual adoption and activity support the narrative. Only after that does technical analysis become truly useful, because timing matters more once you have decided the asset deserves attention in the first place. This order helps each step narrow the decision. Instead of jumping straight to a chart, you first ask whether the asset is worth studying, then whether the evidence is real, and only then how to manage entry, exit, and risk. Strong research usually begins with one precise question. If you start by opening charts, dashboards, and social feeds without knowing what you are trying to learn, you will often collect a lot of interesting information that does not actually help you decide anything. A better approach is to write one specific, measurable question first. such as whether fee revenue is stable, whether user growth is accelerating, or whether liquidity is deep enough for your position size. That question then determines which sources matter and which do not. It also makes it easier to tell when you have actually found an answer. Clear questions protect you from open-ended rabbit holes. Once you know the question, begin with primary sources whenever possible. That means materials closest to the facts, such as official documentation, project announcements, governance proposals, verified contract details, GitHub activity, block explorers, and reputable analytics dashboards. Secondary commentary can be useful later for added context, but it should not be the base layer of your judgment. If you rely only on summaries from influencers or broad news recaps, you are often inheriting someone else's interpretation before checking the evidence yourself. Primary sources help you see what was actually said, built, proposed, or recorded on-chain. That usually leads to better questions and fewer assumptions. Even official information should not be accepted blindly, especially when an important claim affects your investment decision. A good habit is to verify major metrics through at least 2 independent sources. That might include comparing user counts, fees, revenue, or total value locked across separate dashboards and tools. If the numbers are close, confidence improves. If they conflict, the mismatch becomes part of the research, not something to ignore. Sometimes differences are harmless and come from stale updates or methodology, but unexplained gaps are warning signs that deserve attention before you commit capital. Research becomes much more valuable when you turn it into a written thesis. A thesis does not need to be long, but it should clearly state what you believe, what evidence supports that belief, and what would change your mind. That forces precision. Instead of vaguely liking an asset, you are creating a testable statement that can be reviewed later. For example, you might believe an asset has a strong long-term case because users are growing, fees are stable, and governance is functioning well, but you would revisit that view if user growth stalled for 2 quarters. Writing this down makes future decisions less emotional and easier to evaluate. A research log turns isolated observations into a learning system. At minimum, it should capture your original question, the sources you used, the key metrics you checked, your thesis, and the point that would invalidate it. Then, after the decision period has passed, you revisit those notes and compare what actually happened with what you expected. This is where a lot of learning occurs. The point is not just to archive information, but to improve your judgment over time. When you document both the process and the outcome, you begin to see whether your strengths are in asking good questions, finding reliable evidence, timing entries, or avoiding weak opportunities. Imagine reviewing a bridge protocol and asking a very specific question. Does it have enough liquidity to be reliable? You start with primary sources and contract data, then compare total value locked across 2 dashboards. One reports $50 million, while another reports $30 million, which is too large a gap to dismiss casually. After cross-checking, you discover that one dashboard is using a mispriced token and overstating the protocol's liquidity. That finding may not uncover a great opportunity, but it does something equally valuable. It helps you avoid a weak decision. Good research is not only about finding assets to buy, it is also about identifying reasons not to buy. Research workflows only help if you keep following them when markets become emotional. One frequent mistake is relying on summaries instead of checking the source data directly. Another is ignoring on-chain signals for established assets, even though those signals may reveal whether the story still matches reality. Investors also tend to skip their process during FOMO, exactly when discipline is needed most. Vague theses are another problem, because if you never define what would prove you wrong, review becomes almost impossible. A strong routine is simple and repeatable. Ask a clear question, use primary sources, verify important claims, write the thesis down and review later. Section 5. Continuous learning. Continuous learning is not optional in digital assets, because the assets themselves can change after you buy them. Tokenomics can be revised, governance systems can shift, protocol incentives can be updated, and regulation can alter who can access a market or how it operates. That means your knowledge can decay even if you are well informed at the moment of purchase. Price risk is only part of the picture. There is also asset change risk, where the thing you own gradually becomes different from the thing you originally analyzed. Ongoing learning is really a form of risk management. It keeps your thesis connected to the current version of the asset, not just the version you first studied. An investment thesis can go stale quietly. You may still believe the same story, but the underlying facts may have changed enough that the original reasoning no longer holds. Fee distribution can be revised, staking models can be updated, Layer 2 upgrades may change incentives, and new governance rules can alter who really controls the system. None of these changes has to produce an immediate price shock to matter. That is why review should be triggered by changes in the facts, not only by changes in market price. A static thesis in a changing ecosystem is often less reliable than it appears. A durable learning routine starts with primary sources. Official blogs, documentation, governance proposals, dashboards, and explorers are where you can see the full details rather than someone else's compressed version of them. Social posts and commentary can still be useful, but mainly as signals that something may deserve attention. They are a starting point, not a conclusion. Going to the source matters because small details often shape the true risk of an asset, especially around emissions, treasury control, governance power, or incentive changes. When you regularly return to original materials, your judgment becomes more independent and more resilient to hype. Good ongoing learning combines two kinds of signals: direct network evidence and changes in the policy environment. On-chain indicators can show whether usage, participation, liquidity, staking behavior, or large wallet activity are improving or weakening over time. Regulatory developments can change access, compliance requirements, exchange availability, and even how an asset is classified. Both types of change can materially alter the risk of holding something. An asset may look healthy on-chain, but face new restrictions, or it may remain legally accessible while usage quietly fades. Watching both sides gives you a more complete picture of holding risk. The best routine is usually simple enough to repeat. Setting aside 30 to 60 minutes each week can be far more effective than doing occasional deep dives only when the market becomes stressful. During that time, list the thesis changing triggers for each asset you follow, such as upgrades, validator changes, governance votes, token unlocks, fee changes, or regulatory news. Then check primary sources first and review a small set of important metrics. This keeps your process grounded and manageable. Short, consistent habits often produce better decisions than intense bursts of research driven by emotion. Research becomes useful when it produces a record and leads to action. A practical routine might begin with scanning recent governance activity, then writing a short research log entry even if nothing important changed. That matters because repeated no-change notes help you see stability, not just disruption. Over time, those entries create a timeline you can review instead of relying on memory. From there, the decision is clearer: update the thesis, keep holding, reduce exposure, or simply review again later. Written notes make it easier to respond to evidence rather than to mood. Consider an investor who reviews one network every Sunday. Over 2 weeks, he notices validator count is falling, which could look alarming if seen only through headlines or price action. Instead of reacting immediately, he checks developer updates, block explorer data, and governance discussion. The evidence shows that a client bug is causing the decline, not a broad collapse in participation. As a result, he pauses adding to the position until the network stabilizes, rather than selling in panic or continuing to buy blindly. That is a good example of calm analysis doing what headlines usually cannot: explaining the cause before forcing a conclusion. One of the best ways to learn is to verify things directly, not just read about them. A small test transaction can reveal fee behavior, address handling, confirmation times, and user experience. Checking validator uptime can show whether a network's reliability matches its reputation. Carefully simulating a yield strategy with limited capital can uncover operational complexity or hidden assumptions that summaries tend to skip. These small experiments help you see practical risk, not just theoretical opportunity. In digital assets, hands-on verification often teaches more than a long thread or polished presentation. Strong research habits depend on filtering out noise. It is risky to rely on second-hand summaries, to learn only when markets become volatile, or to treat all information sources as equally credible. A large amount of content can create the illusion of insight even when the underlying evidence is weak. A better approach is to favor primary sources, Learn on a steady schedule, rank sources by quality, and focus on a few metrics that actually matter. This also helps you spot stale narratives, where social attention remains high even though governance activity, developer updates, or maintenance quality are fading. In fast-moving markets, discipline often looks quieter than hype, but it is usually more useful. A practical way to build this habit is to choose one asset you already hold or may want to buy, and follow the same review process for 3 weeks. Each week, read one recent technical update, record one relevant network metric, read one governance proposal in full, and write down what changed along with any action you would take. The exercise is not about finding dramatic news every time. It is about building a personal research log that reflects how the asset evolves. By the end of 3 weeks, you will have a clearer sense of whether your routine is actually usable. Consistency, not intensity, is what turns learning into an edge.